You're watching Silver News Daily. Subscribe for more.
What if I told you that silver is about to explode past $100, shattering records and creating one of the biggest financial booms of the decade? Sounds crazy, right? But before you dismiss it, let me show you why some of the smartest investors are betting big on silver right now. With the stock market on shaky ground and economic uncertainty rising, silver is flashing all the signs of a historic breakout. We're seeing massive institutional interest, record high demand in technology and green energy, and a supply crunch that could send prices soaring. And here's the kicker. One key indicator is screaming that silver is still massively undervalued compared to gold. If history repeats itself, we could be on the verge of a silver rally unlike anything we've ever seen. Stay with me, because by the end of this video, you'll see why $100 silver might not be as crazy as it sounds. Let's break it all down.
Leash. And the mama, the holding the leash, is gold. So anytime you think you see silver jumping off a cliff, it's got a leash attached to it. And if gold isn't jumping off a cliff, then silver's not, okay? Keep that in mind. And next thing you know, silver turns around to $1 off the low, that kind of thing. I think we're turning back up after the congestion. Gold got within, a couple of days ago, within $1.50 of its all-time high. And somebody said, I think I'll sell it and risk a nickel to make a dime. Okay, they did. Okay, great. But I think the major trend there remains positive. It remains no longer congestive like it was all during mid-2020 through early 2024, where gold was in this up-down range. In March of last year, we declared that process of corrective process in silver in the miners and sideways process in gold was over. We're going up. Okay. At that point, gold was just above 2,000. At a place it had been 3 or 4 times before in the prior couple of years, so no big deal, but it was to us. And sure enough, you've reached 2,800 recently. Silver at that point was $25, headed toward 26. Didn't mean much on a price chart, but within 9 months it reached 35. Right now we're either side of 31 for the last couple of weeks. I think they're continuing up. I think the main thing to propel them at this point is fracturing of the stock market. When the money flows out of that beast, as it will, it always goes somewhere else, and that place has almost always been gold if you go back through history. And I think that's likely to happen this time. So when you see the downticks in the stock market, take that as a positive background feature for gold.
Right now, silver is trading at $32 on $69 per ounce. But many experts believe this is just the beginning of a massive rally. In fact, some projections are already calling for $50 silver by mid-year, but that might just be a pit stop on the way to triple digits. One of the biggest reasons for this bullish outlook, silver has just formed the largest cup and handle pattern in history. A technical formation that has preceded some of the biggest price explosions in financial history. This is a classic indicator of a breakout, and traders are watching it like hawks. But here's where things get really interesting. Unlike past silver bull runs, this time governments and central banks are paying close attention. While gold has long been a staple of national reserves, silver is emerging as a key financial and industrial asset. Some institutions are even considering adding silver to their portfolios, which could send demand through the roof. And let's not forget silver's growing role in high-tech industries. With supply chains already stretched thin, the industrial demand for silver is at record highs, and it's only getting stronger. Put all of these factors together, and what do you get? A perfect storm for silver to not only break $50 per ounce, but to keep climbing toward $100 and beyond. And if you think that's crazy, wait until you see what's happening with the stock market. Because as uncertainty grows, investors are fleeing into silver at a record pace. Could the next market collapse be the final trigger that sends silver into orbit? Let's take a look.
Range. That means gold miners will have tripled the performance of gold in getting there. Okay? So at that point in time, if we see that kind of breakout, I'm of the view that in this phase of the gold bull market, the miners will wake up and no longer just par perform to gold, but vastly outperform it. And just go back to an old low. It's hardly asking for a home run even. Anyway, there's another relationship to this, a chart below it, which shows similar type behavior of the XAU index, the gold silver miners, versus the S&P 500. And as you can see on that chart, if you go back into the mid-1980s, you'll see it was up at 50%. I mean, the XAU was trading half the price of the S&P at that time. Wow, okay? And it was it declined in a staircase manner, but up and through till 2006, it was still above 20%. Okay, so we're now down at about 2% or so. Price of XAU versus the S&P. Now, it also has a multi-year range at the bottom there, that little deadpan action that you see on the spread. Same thing occurred there, a little better. XAU is actually up more than the S&P over the last 9 years. Hard to believe. But that spread low that we made in late 2015 is actually below the current level, meaning the current spread relationship's higher than, meaning it's actually gained some versus the S&P. So in net price, if you measure where was XAU in December 2015 and now, S&P December 2015 and now, XAU has beat it. Tell somebody at a cocktail party that and they'll laugh their head off, okay? It's a fact. The issue now is to break out of these bases. And I'm suspecting that when you break out of the gold base, XAU versus gold, you'll simultaneously be breaking out of the S&P versus XAU spread base. And if you look at that line that I've drawn on the XAU versus S&P chart, it's up around 18%, where the highs, there was a low back in 93, and then the highs that we reached back at the 2011 bull market peak in gold, XAU then was up around 18% of the price of the S&P. If you go from where you are now, 2+%, up to about 18%, you do the math on the multiples there, okay? It's enormous what the gold miners could do in relation to the S&P. And they've certainly earned the right to do it because that's a 9-year wide base. They've proven we're not going any lower in relative value to the S&P. The only issue is when are we going to turn back up? And that's why I think that you got to watch these relationships, because if these break out, it will coincide with a net price acceleration in the monetary metals and also a downward price in the S&P, but a resurgence in the miners, where, again, money flows out of a broken asset category into tiny subsector of the stock market.
If there's one thing that fuels a massive silver rally, it's market chaos. And right now, the stock market is flashing red warning signs that could send investors fleeing into precious metals. Just look at what's happening. The S&P 500 and NASDAQ are showing signs of topping out, and many analysts believe we're on the verge of a major correction. Some are even predicting a repeat of 2008, or worse. When markets crash, where does the smart money go? Straight into safe haven assets like silver and gold. And history proves it. During the 2008 financial crisis, silver skyrocketed from around $9 to nearly $50 in just 3 years. In 1980, when inflation was out of control and the economy was struggling, silver hit an all-time high of $50 per ounce, equivalent to $180 today when adjusted for inflation. And today, we're facing some of the same problems: rising inflation, mounting debt, and an overvalued stock market. Now, here's what makes this moment different. Unlike past silver bull runs, we're also dealing with unprecedented global economic instability. Trade tensions, currency devaluation, and political uncertainty are all adding to the mix. And here's the kicker: the Federal Reserve's policies are making things worse. As inflation heats up and the economy weakens, the Fed is running out of options. If they cut rates too soon, inflation could spiral out of control. If they hold rates high for too long, they risk tanking the economy. Either way, the dollar's purchasing power takes a hit, and that's when investors rush to silver as a store of value. So let me ask you, If the market crashes tomorrow, where would you rather have your money? In stocks that are losing value, or in an asset that historically thrives in times of crisis? But that's not even the biggest reason silver is set to explode. Because while the markets are crumbling, silver is still massively undervalued compared to gold. And the data proves it. Let's break it down.
Personally bought 4 major silver miners recently, and it is disclosed in all of our reports in the back. I own this and that, I'm emphasizing right now not gold and silver, but silver over gold, but also the miners. The miners are dirt cheap compared to gold. Historically speaking, go back 20, 30 years, you can look at the relationship between them. And also the gold miners, as a subsector of the stock market, are off the page cheap compared to the S&P. But that sort of hides the truth. The top chart shows the XAU index, which is the Philadelphia Gold and Silver Miners Index. It's been around a long time, since the 1980s, so this is why we use it. It's got a lot of history. And when you look at that spread chart versus gold, you'll see that the spread relationship between XAU and gold, and what we do to measure that is we measure the price of XAU divided into gold expressed as a percent. And so back in the 1980s through 2008 or so, XAU index was trading at 25, 30%, even got up to 38% of the price of gold. XAU versus 1 ounce of gold. And the lows were around 17, 18%. Meaning whenever you get a dip and the price of XAU dropped to about 18%, it would find support. And so in that top chart, you'll see there was this range at a high level. But in 2008 and 9, just prior to the onset of the gold bear market, the spread broke, where the miners started to break in relation to gold, and their performance collapsed down to when? To the December 2015 low. So the spread, in other words, the lessening performance of the miners versus gold, dropped until gold and silver and miners actually made their price low, which was December 2015. But if you look at that spread chart, you'll see that over the last 9 years, since late 2015, the spread has gone sideways. Yes, at a very depressed level, but it hasn't gone down anymore. Now, you say, well, that's a dog. Well, actually not. Right now, the spread is a little bit higher than it was at the close of December 2015. Now, what does that say? It says that miners have been a par performer, sideways performer to gold, meaning they've gone up just as much as gold has during the last 9 years. You tell the average investor that and he'd chuckle, but it's a fact, measurable fact. The miners have matched the gains in gold. The question is now, when do they break out? And you can see I've plotted a 3-point downtrend line on that spread. But there's also this basing range of 9 years. I think we're going to break out of this range. And we measure various things to determine when that's occurring, not just this spread chart. But when you break out, look at that line overhead on the spread. The old lows at about 18% over. That's resistance level now. It was support for years and years. If you break out now from where we are, you're likely to find resistance up there. But let me tell you, we're trading just above 5% now. That's a triple and more in the spread relationship. What that says is if that spread breaks out and you even just go to the bottom end of the prior multi-decade.
What if I told you silver is one of the most undervalued assets in the world right now? It might sound crazy, but the numbers don't lie. Right now, the gold to silver ratio is sitting at 88.33. Meaning it takes 88 ounces of silver to buy just 1 ounce of gold. And historically, every time this ratio gets this high, silver explodes in value shortly after. Let's look at what happened in the past. In 2011, the gold to silver ratio hit 31, right before silver skyrocketed to nearly $50 an ounce. In 1980, the ratio dropped to 15 as silver hit its all-time high. The historical average for this ratio? Between 50 and 70, which means silver should already be trading between $40 to $60 right now. And it's not just history pointing to a silver boom. Gold itself is already flashing a warning sign. With gold hitting new all-time highs above $2,058, silver is still lagging behind, but that won't last long. Here's the thing. Silver moves fast when it finally starts running. In past bull markets, silver has outperformed gold by 2x to 3x, meaning if gold continues climbing, silver could go parabolic. And if the ratio corrects back to historical levels while gold stays above $1,800 per ounce, silver could easily break past $100 per ounce. So let's connect the dots. The stock market is shaky, inflation is eroding wealth, and silver is sitting at a massive discount compared to gold. The smart money is already taking notice. But what about the institutions? That's where things get even more interesting, because governments and central banks are now paying close attention to silver like never before. And that could be the biggest game changer yet. Let's dive in.
Pivotal point in our reports, because we look at all four major asset categories. We don't just look at gold and silver. You can't do that. They're impacted by other markets that impact central banks, that impact the growth in money, et cetera, et cetera. So they're all tied together. And when you break the stock market, I think that's when you will start to see the verticality, which we've already seen some pretty good stuff. If you stand back and look at it, ignore the zigzags that always occur. Gold, for example, last year closed at 24, close of 23 to close of 24 was up more than the S&P. Silver matched basically the S&P. Nobody cheered that. It wasn't on the major financial channels. It was all stock market. So they've ignored that reality. And I think you'll start to see a further separation where gold continues up and its related markets, and the other paper assets start to bleed. And when they bleed, that money goes somewhere. Now, as far as silver versus gold, it's dirt cheap off the page. We know that, historically speaking. Now, it's either fundamentally lost any rationale for being, okay, which we know isn't true, or it's an error. Silver's just priced too low. These things happen in markets. Markets get priced too high and they pay the dues. Markets get priced too low for so long and they go up, and you hardly need an excuse. It's just that they were underpriced for too long. And I think silver's in that category. Technically, we can measure the spread relation between silver and gold. And I've got some numbers that we're monitoring that wouldn't take much on the upside over the next few weeks even, where silver gains a bit to gold, and it will break out on these technical metrics of the measuring the relationship between the two. And I would bet that would probably coincide with gold, one, being back to and through its highs, 2,800, but silver also back up to its highs, 35. At that point in time, silver's still cheap to gold. I mean, like you said, gold's way over its 2011 high and so forth. Silver's not above its dual highs at 50. I think it's the next move that's likely to blow that stuff out. And I don't think 50 is a target, by the way. If we get going in this next leg, and I think we will, stock market being a key factor, that $50 is just it's a paper target. Everybody's looking at it, but you'll blow it out. You'll go well up in between there and 100 or something. I've got some reasons to think the mid-60s before you even stop for a pause. But the key right now is that what happens in this current situation, break that stock market, break the Sensex, break the Nikkei, and you'll have central banks go berserk, and we know what wins when they go berserk.
What if I told you silver is one of the most undervalued assets in the world right now? It might sound crazy, but the numbers don't lie. Right now, the gold to silver ratio is sitting at 88.33, meaning it takes 88 ounces of silver to buy just 1 ounce of gold. And historically, every time this ratio gets this high, silver explodes in value shortly after. Let's look at what happened in the past. In 2011, the gold to silver ratio hit 31, right before silver skyrocketed to nearly $50 an ounce. In 1980, the ratio dropped to 15 as silver hit its all-time high. The historical average for this ratio? Between 50 and 70, which means silver should already be trading between $40 to $60 right now. And it's not just history pointing to a silver boom. Gold itself is already flashing a warning sign. With gold hitting new all-time highs above $2,058, Silver is still lagging behind, but that won't last long. Here's the thing. Silver moves fast when it finally starts running. In past bull markets, silver has outperformed gold by 2x to 3x, meaning if gold continues climbing, silver could go parabolic. And if the ratio corrects back to historical levels while gold stays above $1,800 per ounce, silver could easily break past $100 per ounce. So let's connect the dots. The stock market is shaky, inflation is eroding wealth, and silver is sitting at a massive discount compared to gold. The smart money is already taking notice. But what about the institutions? That's where things get even more interesting, because governments and central banks are now paying close attention to silver like never before. And that could be the biggest game changer yet. Let's dive in.
Help. It did help gold. And it did help T-bonds during that period of time. And even longer for gold. Gold went up through 2011. This time, I think, when the panic sets, we're going to see a lot of exposed errors. The kind of fundamental mistakes that corporations say, oops, we shouldn't have done that. Families say, oops, we shouldn't have done that. And those errors, when exposed, will impact data points. This is what the Fed likes to talk about. You know, they're scientists, right? Okay. So look at it, the scientific data points. Those data points are going to go dark very quickly. It's very rare when a bear market starts in stocks that the data points went south in a hard way first. They go south last. They follow the stock market. And what's the Fed going to do? Well, you want to place a bet? They're not going to be fooling around at that point. They're going to realize, we kept it too high too long. And they've got a lot of critics out there, even friends of the Fed, who've been arguing, you guys kept it up there too long. You need to cut. And they'll have the excuse to do so, not just because Donald Trump tells them they got to cut rates, but because they'll have the data points and the argument to do so. And monetary expansion, and we won't be the only ones. Because when you survey the world, right now, I would say China and emerging markets are far less vulnerable than we are. Why? They're only double from where they were at the 2009 low. They're not bubbles, okay? So yeah, they could economically turn down with us. Naturally, they would. We're a world marketplace. And even Europe, you look at the Euro Stoxx 50, which is the blue chips of the Eurozone. Nowhere compared. It's only double and a half from the 2009 low. But watch India and Japan. India's up 12-fold since the 2009 low. S&P 500 has gone up 9-fold. And the Nikkei went up 6-fold. So those three markets, which are key economies, India and Japan, they're not, developing countries, okay? When they snap coincident with us, and right now they are breaking our technicals. MSA has long-term momentum trend factors. And I would say the Nikkei right now, about 1% below where it is, closed the month, any month this quarter, it's over. Sensex is already well below its breakage point, India. And you take NASDAQ down back to those price lows we just saw and close a week there, it's over. Now those will cause data points. And again, what does gold live for? It's money. It's money. And when the government degrades the paper money, the real money rises.
Silver isn't just a precious metal. It's an essential industrial resource. And right now, demand is exploding while supply is struggling to keep up. Here's the reality. Silver is irreplaceable in modern technology. It's the most conductive metal on Earth, making it critical for solar panels, electric vehicles, artificial intelligence, and advanced semiconductors. And the numbers speak for themselves. In 2024, silver demand hit 1.21 billion ounces, marking one of the highest years on record. The solar industry alone consumed 67 million ounces of silver in the U.S. last year. Electric vehicles, EVs, use 25 to 50 grams of silver per car, and with millions of EVs expected by 2030, demand is set to surge even higher. AI and data centers are also pushing silver demand higher, requiring high-performance semiconductors that rely on silver's unparalleled conductivity. But here's the real problem. Silver supply is shrinking. The Silver Institute projects a 150 million ounce supply deficit in 2025, the fifth consecutive year of shortages. Unlike gold, silver isn't just mined. It's mostly a byproduct of other metals like copper and zinc. If those industries slow down, silver supply plummets. Recycling alone can't make up for the gap, and new silver mines take years to develop. So let's connect the dots. Silver demand is at record highs, supply is drying up, and governments are stockpiling. What does that mean for prices? It means we're looking at a massive supply squeeze, and in past shortages, silver prices have gone parabolic. But could all of this really push silver past 100 per ounce? That's what we're about to break down in the final section. And trust me, you don't want to miss this.
Stock market bubble in U.S. history. You go back and look 1923 to 29, look at the age of the bull trend, percentage dynamics on the upside. Look at the dot-com move, mid-90s to 2000, percent gain over what span of time. And then the move from the 2002 low to the 2007 high, the real estate mortgage crisis bubble. Each of those was far less long-term, in terms of years accumulated, and second, in terms of upside dimension. And you say, well, I guess the economy's been good. Well, instead, go to the St. Louis Fed site and punch up an M2 chart, money supply, and look at the rate of growth over the last 15 years compared to any other 15 years. And then especially look at the Fed funds rate chart, the rate that the Fed controls, the very short end of the market. Never have we seen, the last 10 or 15 years, free money for 10 or 15 years, effectively. There was an uptick there prior to 2000, and then they yanked it back down when COVID occurred, kept it at zero for a while, then took it back up again. Now they're cutting it again. But of the last 15 years, 10 of those have been effectively zero rates. And even with the rate rise we saw that ended a year ago, they paused and now they're starting to retreat. Even that peak was very low historically when you go back 50 years and look at interest rate levels. So there's a good causative factor of why is this particular asset category, this paper asset category, the stock market, so boosted over such a period of time. Well, it had, a drug injection in its arm, okay? Free money. And that's one of the key factors that anybody integrates into their thought process when they're making an investment commitment, a commitment to build new factories. Hey, dear, let's build a new house, buy some new property, and so forth. So all kinds of decisions, personal and corporate and government, are based on the cost of money. Well, if that was false for 10 or 15 years, then a lot of errors have been made. And so somebody who comes into office now with the idea, well, we're going to go more free market, we're not going to have government spending like it used to be. The problem is it's too late. You already have a bubble of monstrous size. And when it unleashes, you can do anything you want to do, cut rates to the bone, and it's not going to help. In fact, if you go back and look at any of the bull peaks and bear markets that followed, 29 to 32, the mid-70s to the 74 low, the dot-com peak to the 2002 low, and the 2007 peak to 2000. They cut rates all the way down, and it didn't.
We've just broken down every major force pushing silver toward one of the biggest price surges in history. The stock market is on shaky ground, and when crashes happen, investors rush into safe haven assets like silver. The gold-to-silver ratio is screaming undervaluation, meaning silver has massive upside potential compared to gold. Governments and central banks are taking silver seriously, stockpiling it for both financial and industrial security. And industrial demand is at record highs, while supply shortages are only getting worse. Put all of this together, and what do you get? A perfect storm for silver to break $100, and maybe even higher. Now the question is, are you ready? Will you wait until silver is already skyrocketing? Or will you position yourself ahead of the biggest precious metals boom of the decade? If you found this breakdown valuable, don't forget to like, subscribe, and hit the notification bell so you never miss the latest insights on silver and financial markets. And remember, this isn't financial advice. Always do your own research before making any investment decisions. Thanks for watching, and let's see where silver goes from here.
The last couple quarters, actually. And if you look at the S&P, just for example, right now you're trading, probably about where you were in the peak in mid-July. Okay? So you've gone nowhere. Okay, yeah, you've been up, you've been down, but it's really not the dynamics. If you even just stand back and look at price since the 2009 low, then the pullback into 2022, and then since 2022, it's really getting sluggish up here. And the S&P made a new high in order to get those headlines. You know, they love it. All-time new high, Trump's elected, all this stuff. NASDAQ 100 did not. It missed it by a little bit, no big deal. But the spread relationship, which a technical feature we measure between the S&P and the NASDAQ 100, NASDAQ 100 being the leader index. Leader meaning it was the most percent gainer from 2009 to the present, and it will be the most percent loser once you go into a bear trend. This was the case back at .com, for example. You know, internet was going to take us off the planet. It changed the world. And in fact, it did, but the NASDAQ 100 dropped 82% between 2000 and 2002. It was the leader then, it's the leader now. The technicals we see on NASDAQ are such that the recent price lows we've seen a couple weeks back, which were just below 21,000 in the 20,700, 20,800 zone, I'm talking NASDAQ 100 now, you don't want to go back there again and close a week there. Not because of price, but because we run quarterly momentum of the NASDAQ 100 and the S&P. S&P's already fractured itself prior to the recent rally. But the NASDAQ has yet to break our key structure. And when it does, we think there will, in fact, be a sharp layered decline. It doesn't have to be a crash. Could be, but, it doesn't have to be. Instead, I think you probably should expect something more like the bear market. I think that's what it will begin. Will commence in double-digit percent slabs of decline. You're like, you get to those numbers that I just defined, you could drop another 5 in a second because there's no more support for another 5%. When you blow that level, you could really start to go down in a more panicked way. And it's the panic factor that is not in the market. Most of the people who've been bearish based on, the norms of excess that people look at, the old textbook things, fundamental type things. They've been skeptical for some time, and yet it's not gone down. So they're really frustrated. And most of them are just now, we need a correction. They've given up on the bear market idea. We have not. Okay. We think we have the biggest